Welcome back. I'm here with Alfred Lee from BMO Asset Management. We were talking about gold possibly being an inflation hedge or not, which brings up another question, Alfred, crypto. Because crypto, certainly before we saw this massive sell-off, was seen as an inflation hedge, and its performance definitely says otherwise. You know, crypto is just such a massive space. But generally, there's this debate that it acts as a currency or it acts as a commodity. What's your take?
I think when you consider it as a currency, I think, where we are right now, it definitely is not a currency. To satisfy the definition of a currency, it has to be a medium of an exchange, which it's not. It has to be a store of value, which it's not. So definitely doesn't satisfy either of those definitions. But when you say it's a commodity, I would argue that potentially it is a commodity. When you compare it to gold, gold, at the same time has no monetary value as neither, right? It has value because we believe it has value or because it used to be part of the monetary system. When you compare to digital assets like Bitcoin, I would say, in terms of a technology perspective, it's definitely a lot more efficient, a lot better than gold. But I think potentially it has the potential to move towards being a commodity, very much like gold. But in terms of being, replacing a currency, I think we're still very far away from that, given that governments likely don't want to give up control in terms of having their currency replaced by something like Bitcoin at the moment.
Okay. I want to talk a little bit about how commodities, the performance of commodities work relative to stocks, right? Because typically stocks, the stock market, over the long run, we see dips, but the trajectory has always been up. That's not necessarily the case with commodities, right? They're more cyclical. So
Mhm.
does it make sense to buy and hold, or does someone have to be a little bit more strategic when they're investing in commodities?
It's a great question. I mean, when you look at commodities, commodities definitely have this long super cycle that they go through. But in terms of buying and holding in a portfolio, from my perspective, it's a great diversifier because when you look at even your typical portfolio, let's say your 60-40 portfolio, which is your prototypical balanced portfolio, 60% in equities, 40% in fixed income, you're missing a big piece of the puzzle, right? I mean, commodities is another asset class that ebbs and flows very differently, as you mentioned, compared to equities and bonds. So as a result of that, it's a great diversifier. The challenge, however, is that, up until 10 to 15 years ago, it was very difficult for investors to access commodities. It was through, a commodity pool, for example. But, with the, innovations in the ETF space, it really has changed the game where, not only institutional investors, but do-it-yourself investors can now access things like commodities very easily. I mean, as we mentioned before, you could buy a gold bullion ETF. You could get an ETF that accesses gold, oil or silver, any commodity under the sun. Basically, is accessible through an ETF, even Bitcoin.
But for those people who, I guess, are looking at commodity stocks, right, say gold producers or something else, what do they have to consider? I mean, you're a portfolio manager, so you must have to go through this.
Yeah, I mean, there's that's a great question because there's so many different ways in which you could access commodities, right? I mean, you could get it through the companies, and the challenge there is that it may not give you pure exposure to the commodity. For example, if you invest in an oil company, it's not going to be a direct correlation to oil prices. Same thing with gold and gold companies. You could access commodity exposure through the futures market, which ETFs in some cases will hold futures, but the challenge there is that it could have some slippage depending on what that futures curve looks like. The benefit, however, is that through a futures ETF or an ETF that holds commodity futures, is that you could basically access any commodity you want. The other way you could access commodities is through an ETF that has exposure or holds things like gold bullion. The challenge there, even though it is a perfect way to hold it, is that if you want exposure to things like oil, for example, you can't simply just get a tanker and sits there and holds oil, right? So
Yeah, yeah.
it only is applicable for a few commodities.
Okay. 20 seconds. And a quick question for some of these commodity stocks, are you seeing them feeling the pressure of inflation?
For sure. I mean, a lot of these companies, they've actually been very, they've been able to offset a lot of the inflation,
Okay.
just because as commodity prices go up, their profit margins tend to increase. So a lot, and because commodities have been in high demand, a lot of those inflation pressures they've been able to push on to the end consumer.